can we do to bridge the traditional world of banking and finance and this exciting new world of decentralized finance and crypto, and created EQIFI so that there is that bridge that allows you to transfer value back and forth. And in a showcase manner, we wanted to do it in a licensed and regulated way.
Welcome everybody to another episode of Inside the Market presented by StockPulse.com. We are more than honored to be sitting down today with Brad Yasar, the CEO of EQIFI. Thanks for joining us today.
Thank you for having me, Justin.
Pleasure's all ours. I'm excited to get into crypto markets. It's been an exciting year in the crypto markets generally. Obviously, we've seen what Bitcoin's done in the wake of the March 2020 sell-off. Bitcoin rebounded quicker than virtually any asset or commodity on the planet. And then we had the summer of DeFi in 2020, and that evolved into a meme coin craze, which I've heard some people describe as the blow off top in crypto markets. Dogecoin from under a cent to 70 cents when Elon Musk joined SNL, and some people sold on that news, others did not. And then into really NFTs. And here we are at the end of 2021, and that's been the story. So I'm excited to talk about crypto today.
Well, crypto has been a very interesting alternative asset class from its inception with Bitcoin and early days as an experimental value transfer network and mechanism to fast forward today, just like you said, being almost a part of every single industry and every single facet of life. It's grown a lot in the last 12 years. Obviously, the initial iterations of crypto were around the distributed ledger. How do we keep a distributed ledger? How do we have a trustless system where there's not a trusted party in the middle? Then it evolved into, of course, practical applications of the technology. And then you started seeing exciting projects built on Ethereum, decentralized finance, non-fungible tokens that allow tracing of ownership of different both digital and physical assets with the use of the blockchain. As well as several other more complex and forward-looking applications like liquidity pools and other products that came to be in just the last 4 or 5 years that didn't exist before.
You mentioned distributed ledger technology, and that brings to mind how I believe around 2015, a lot of big corporations began examining blockchain technologies, particularly how it could be applied to supply chain tracking. And fast forward many years later, 5 or 6 years later, and it's very interesting that this same exact technology has now been rebranded and represented as NFT technology, which in many ways is similar to the supply chain tracking technology that was being built on, I guess, enterprise blockchains like Hyperledger, Corda perhaps, but certainly also on Ethereum in its nascent days. So I guess we've then experienced the DeFi craze. And so could you kind of define what DeFi is for people and how it's unique from some of the other niches in crypto?
Of course, I'll touch a little bit on NFTs because your illustration and example is spot on. The earlier supply chain solutions proposed were NFT-based technologies. So it's the underlying technology of having either fungible or non-fungible unique assets on the blockchain is from the beginning, and now we're seeing different applications, and I think that goes to hand in hand really well with DeFi too. DeFi stands for decentralized finance. So in the traditional finance, there are central authorities that facilitate the service or the product. It could be a bank, it could be a financial institution that you trust. You either put your trust in them with your funds or your business or your loans, and you say, okay, these people are trusted entities, they're licensed and regulated in my country or the jurisdictions I operate in. So there's that trust factor. What DeFi came up with is there is a cost associated with having a central authority govern everything. So if I were to loan you some money 10 years ago, I would put my money in a bank because I didn't know who you were or how trustworthy you were that you're going to make payments on the loan. The bank would then take that money and you would go to the bank and say, I need a loan for this purpose. Now, the bank has your bank history and credit report. I don't. They have my bank history and credit report too. So they would do that matching. I'm simplifying the process. Of course, it's a pooled system. It's not like this, and then the money I deposited would go out to you as a loan. And that infrastructure is very costly to maintain. What decentralized finance came up with is ways to replicate those products and services that exist in the traditional space, but reduce the cost to a level where it can be a peer-to-peer transaction. Because there's no trusted authority in the middle that has to do all this research on both of us and transfer the money from one to the other, because we can transact directly on decentralized platforms with products, now we can have microloans that are peer-to-peer. I need $500, you have $500 extra, you can loan it to me and have the peace of mind that I can't run away with it. I'm going to pay it back, or my collateral's gone, or whatever I'm risking on the platform is going to be lost. So that shift from we need a central authority, we need bank branches, we need financial institutions to, hey, I can borrow and lend from my computer, really fueled the DeFi boom. Then you started seeing these decentralized exchanges or DEXs, which actually contributed a lot to the DeFi space because they showed that you don't need a centralized exchange. The same thing with centralized exchanges and centralized other institutions is the cost. Someone has to own and operate it. They need to have a certain amount of liquidity to work, and they need to be regulated. Not that decentralized exchanges shouldn't be, but when you go to a peer-to-peer model where I provide the liquidity for a trading pair and earn fees on it, now you don't need big market makers. Now you don't need to qualify projects being listed on that decentralized exchange because it's all peer-to-peer. Everyone has to do their own research. As your viewers are familiar with, you always want to learn about what you're investing in and the risks associated with the investment. But it kind of shifted the mindset from, oh, we need to have someone hold our hands to, no, we can do it among ourselves within the community. And I think that was the biggest shift in mentality that DeFi brought.
Can you explain the consequences of that shift in mentality and where it could lead?
Yeah, I mean, there are a lot of consequences, both intended and unintended. So the positive consequences are, of course, access. A lot of people who couldn't get a US stock brokerage account now was able to trade on these decentralized platforms because you just connect your cryptocurrency wallet to them, and then you can become a liquidity provider. You can exchange your assets on there and either pay or earn fees in a decentralized manner that no one has oversight over. It's programmatic. So that opened up the world to a lot of economic activity. It also even the playing field a little bit, because before crypto, if you had a really good idea that you wanted to bring to life, you had to go fundraise. And of course, in the United States, we have a very healthy and flourishing angel early stage venture investment community. So there are opportunities for entrepreneurs to get the money they need to build these exciting things. Elsewhere in the world, even in Europe, it's a very different story. People don't have access to early stage capital like that. So through these mechanisms of tokenization and DeFi and liquidity pools and fair launches, people were able to get the funding they need to build a lot of cool stuff and create value globally. And that's been another positive consequence of this. Now, on the unintended or negative side of things, because a lot of the early stage projects didn't believe in being licensed and regulated and operating in a transparent way, what happened is that lent itself to situations where those projects were compromised, whether an outside hacker or poor audits or what have you. When you take the trust factor from a centralized entity and human beings to a decentralized model and program, basically a programmatic oversight mechanism, you're only as good as the code you wrote. So there have been numerous very public instances of hacks and exploits and unfortunately theft of this incredible value created in the DeFi, because they went with fully anonymous. You don't know who the creators are, you don't know where they live, what jurisdictions they're in, and you're just blindly trusting the code, which has proven in some instances to actually be a negative consequence and create a lot of loss of investment and value.
I consider NFTs decentralized finance in a way, in some ways, perhaps only in niches of NFTs. I certainly, I consider Bitcoin too decentralized finance as well. Of course, there's a sliding scale. Some of this technology is intended to be centralized initially and then decentralized at a later date. That's what Jeff Garzik, who was an early Bitcoin developer, talks about in a decentralized flight path. And that's the path he's taken with Metronome and many other of these decentralized financial technologies have taken. There's also a debate about just how decentralized they are in their final form or in a later stage form. But generally speaking, I personally consider NFTs to be a type of decentralized finance. Do you agree?
They can be, of course. So when you say decentralized finance, just like you said, there are levels of decentralization, and then there are levels of finance. If you consider a simple Bitcoin transaction a financial transaction, which it is, then yes, you can say Bitcoin is the beginning of decentralized finance because it uses a decentralized structure and allows you to transfer value. I think the time DeFi was coined was more when more sophisticated products like lending, borrowing, yield came to be. And that's when people started using that label for it. NFTs are just a technology. It's a type of asset on certain blockchains that are unique instead of being fungible. So NFTs can be DeFi. If an NFT represents, let's say, a plot of land, and you're fractionalizing it or you're selling it, then yeah, it's a DeFi product. An NFT can also be art, where it has nothing to do with finance. It just represents something beautiful, either visually or musically or whatever it represents. So it's basically a really good way of tracking ownership and provenance. And the one thing that's really exciting about NFTs is the royalties that you can tag on to them. Because before NFTs and this new protocol, when you exchange any crypto, the prior owner didn't get anything. So if you sell me one Bitcoin, I pay you for the Bitcoin, and the person who owned that Bitcoin previously doesn't get anything. The person who mined that Bitcoin doesn't get anything because they already sold it, it's not theirs. The really exciting thing about NFTs, whether it's used in DeFi or in art world or in any kind of setting, is you can tag a royalty onto it. So the creator of the NFT can have a continuous stream of income from each sale. And that, at least in the art perspective, was a game changer. That's why we saw that huge boom of both very traditional and new media artists jumping on the bandwagon during COVID times, because they realized now I can earn royalties, which was missing both from the visual artists as well as audio artists in the recent history.
On the NFT front, I've seen NFT examples where they are able to accrue other NFTs, sometimes through the actions of the owners. Aavegotchi comes to mind. So you can play a game with your Aavegotchis essentially, which is not on the blockchain, but I think is adjacent. And you can essentially give them strengths. You can like give them better temperaments by helping them interact. It's like if you had a Tamagotchi, which was the device back in the, I guess, 90s, probably before that too, where you essentially had to feed a digital, what would you call it even? Creature. And if you didn't, they passed away. And it's the same idea here with Aavegotchi, but now there's, when you accrue other NFTs, which is a form of value, which can then be seen as a collectible. It could be rare, etc. And that's one layer of the NFTs. Then you mentioned plots of land, and these plots of land can also be, I guess, also in the metaverse. Now, digital plots of land, you can own a plot of land next to Snoop Dogg if you want on a certain metaverse, and it's going to cost you. Can you explain kind of that side of things, the metaverse?
Absolutely. That's a really interesting segue because I was going to say with EQIFI, we actually have an NFT card that you can use in the metaverse as a debit card. And then you, as soon as you get the NFT, you actually receive a physical card that you can use in the real world. So that's again, a DeFi banking kind of use of NFT. Metaverses have always been very interesting to me personally, because I got involved with Second Life in the late 90s, early 2000s, and that was a completely non-crypto metaverse that was created, and real world value like US dollars were being spent buying stuff and renting and using stuff in that world. And then fast forward to last year, we saw an explosion of metaverses, because the biggest challenge with pre-blockchain metaverses was the ownership. Like, you never actually owned the virtual items, the virtual value created on those worlds. You played a game, you created an incredible maybe avatar and a setting, and then when you stopped playing the game, or if the software developer stopped supporting it, that's it. All that value was lost because you couldn't transfer it out. With metaverses now and NFTs being the underlying technology, you own the assets in the metaverse. If you own a plot of land, no one can take that away from you. Furthermore, if the original developer stops supporting the metaverse, anyone else can, because it's distributed. It's not on someone's Amazon servers or someone's traditional rack servers that they can just pull the plug and then there's no more game, no more metaverse. No, these exist in a decentralized fashion on decentralized blockchains, which is very exciting because you have permanency. Add on top of that the ownership with the NFTs, and just like you said, now it doesn't matter where you live, where you come from. If you get into a project early enough, you may be neighbors with Snoop, you may be neighbors with the president of a country. You never know who's going to be your neighbor. And there's a vibrant socioeconomical structure being defined right now that we're excited to be a part of. EQIFI is the first bank to open branches in the metaverse, and there's about 12 or so live metaverses, and we're in conversations with all of them to create either a building or a representation of a financial checkpoint. Maybe it's a zone you teleport into, or something exciting like that, and have people be able to access their bank accounts, their crypto, their whatever financial needs they have. They're going to be able to do it in the metaverse.
Okay, so I think this is a pretty abstract concept for a lot of people. So like even starting with the debit card, it's like, so for me, and I'm pretty versed in this industry, I don't even know what that means, but does it mean, I'll just take a guess, that it's a debit card with NFTs on it?
No, it's an NFT that's a debit card. So in the metaverse, let's say you go to some place where you can transact, a flower shop. You want to buy some virtual flowers to your wife, girlfriend, mom, and they're in the same metaverse as you are, of course. You can go and use your virtual card to buy that, but that's not the exciting part. The exciting part is with that NFT card, you also have a physical card. So let's say you're in a play to earn kind of metaverse or game where you're earning some income just playing, existing, doing stuff in this metaverse. You can take that and go to a supermarket and buy food with that value you created. So it's a virtual NFT card that mirrors a physical real world card that we created. And the value between the virtual world with crypto is accessible by fiat wherever you are. So someone in Philippines can go to our virtual branch, deposit the play to earn coins they got in whatever games that they play, and then leave their homes, get out of the virtual realm, go to a supermarket and buy food with them.
So I'm curious about like some of these concepts that you've mentioned, and then I want to get more into like what EQIFI does. For instance, like play to earn. So how would the card work in a play to earn scenario?
Well, play to earn is what all the gamers, me being one of them all my life, have been waiting for. There are a lot of people that are very passionate about spending time in front of a screen or in a VR headset and performing certain activities and creating value in that ecosystem. Prior to, again, blockchain and crypto, that value was locked in that walled garden. As long as you played the game, you were a superhero. As soon as you shut it off, there was no benefit to it, to the chagrin of a lot of parents in the past couple decades. I'm sure they would have wanted the play to earn to exist before, so their kids didn't waste all that time playing games. But with play to earn, you can earn cryptocurrencies in a game setting. What we're allowing that to turn into is for that game currency to be used in a real world setting, because we're doing behind the scenes all the conversions and exchanges and everything. So when you are in the game, you see your game credits, so to speak. And when you're outside the world, you see the US dollar value or the euro value of that. And we allow you to spend it.
So what other ways are banking and crypto and DeFi being married, either at EQIFI or generally?
Generally, there has been a lot of resistance from banks to embrace DeFi and crypto, which is the genesis of why we created EQIFI. We saw a lot of value creation in the crypto space, in the DeFi space, where people are working very hard and creating incredible things that are going to shape our future. And by all means, not every crypto project is perfect or legit. So I'm not giving a blanket endorsement to everything crypto here. I just want to point that out. But there's a lot of good stuff happening. And because of the uncertainty introduced by governments not being able to find the right regulatory framework to frame these activities, a lot of the banks globally have said, oh, we're not going to touch crypto. And if you touch crypto, we're going to close your accounts. And we don't want to deal with it because it's high risk, which kind of indirectly criminalizes any value creation in a nascent technology that's gonna positively affect our lives. So what we saw is an opportunity to bring positive returns to bank clients on the EQIBank side, because again, euro accounts are negative interest rates. British pound is negative interest rates. Japanese yen. I mean, there's a lot of instances where you deposit €1 million into a bank account, and at the end of the year, you get a statement that says you have 980,000. And if you ask what happened, they're like, well, negative interest rates and fees and this and that. So the value that you worked so hard to create is eroded. And we thought that's not right. Add on top of it the lack of connection between the value created in crypto and DeFi and the real world uses of that value. I know a lot of entrepreneurs in this space that created millions of dollars of value for themselves and can't even buy a new car, can't even sometimes pay their rent because they can't access that value because the bank says, oh, we don't want to do it. So knowing those challenges, we said, what can we do to bridge the traditional world of banking and finance and this exciting new world of decentralized finance and crypto, and created EQIFI so that there is that bridge that allows you to transfer value back and forth. And in a showcase manner, we wanted to do it in a licensed and regulated way. So we didn't go completely anonymous. You know, our products and services and the whole team is fully transparent. We're licensed and regulated, because there was a lot of people in DeFi saying, oh, you can't be a licensed and regulated entity and do DeFi. And we wanted to prove them wrong. There were a lot of people that said you can't be a bank and deal with crypto. We wanted to prove those people wrong, because I believe the future of banking and finance is the DeFi model.
We've had the honor of sitting down today on this episode of Inside the Markets presented by StockPulse.com with Brad Yasar, CEO and founder of EQIFI. Brad, where can people find you and EQIFI?
They can go to eqifi.com. It's EQIFI.com. And they can reach me through the website. I answer a lot of the questions that are directed to me directly, or if they use Telegram, I'm at bradyasar.com. I'm at Brad Yasar on Telegram too.
Thank you, Brad, for joining us, and thank you everyone for listening.
Thank you for having me.